Imagine you're walking through a vibrant marketplace. Vendors are shouting, buyers are haggling, and everywhere you look, there's something being bought and sold. Now, picture this marketplace on a massive global scale. That's the stock market. It's not a physical place, but a dynamic and ever-changing system where businesses and investors come together to trade ownership and build wealth. But what exactly is the stock market? Why does it exist? And how does it affect your life? In today's video, we're going to break it all down so you can understand not just how the stock market works, but why it matters. By the end of this video, you'll feel confident enough to explain the stock market to anyone, even a 5-year-old. Let's get started. To understand the stock market, we need to start with its foundation. Stocks. When you buy a stock, you're buying a small piece of a company, known as a share. Think of it as owning a slice of pizza from a much larger pie. If the company does well, the value of your slice means your stock's value increases. If the company struggles, your stock loses value. This system allows businesses to raise money by selling ownership, while investors have the opportunity to grow their wealth by betting on the company's success. The stock market exists because businesses need capital to grow, and investors need a way to put their money to work. Let's take an example. Imagine a tech startup with an innovative idea but limited funds. To raise money, the founders decide to sell shares of their company to the public. These shares are then traded on the stock market. Investors who believe in the company's vision buy shares, providing the business with the funds it needs to develop new products, hire employees, and expand operations. In return, these investors hope the company's value will increase, boosting the price of their shares. But where does all this trading happen? Stock markets are platforms that facilitate buying and selling. The two most famous stock exchanges in the United States are the New York Stock Exchange and the NASDAQ. These aren't just random places where people shout numbers. They're highly organized systems with strict rules to ensure fairness and transparency. Today, most trading happens electronically, with transactions completed in fractions of a second. For example, when you buy a share of Apple, your order is processed almost instantly, thanks to advanced technology. Now, let's dive into how stock prices are determined. At its core, stock prices are influenced by supply and demand. If more people want to buy a stock than sell it, the price goes up. Conversely, if more people want to sell than buy, the price goes down. But what drives this supply and demand? It's a mix of factors, including company performance, economic conditions, and even investor sentiment. For example, if a company announces record profits, its stock price might soar as investors rush to buy. On the other hand, if there's negative news, like a major lawsuit or poor earnings, the stock price might plummet. Let's make this even clearer with an analogy. Imagine a popular concert where tickets are in high demand. If more people want tickets than there are seats available, ticket prices skyrocket. Similarly, when a company is performing well, its stock becomes highly sought after, driving up its price. The opposite happens when demand drops. It's like trying to sell tickets to a concert nobody wants to attend. The stock market isn't just a place for individual investors. It's also critical for businesses and the economy as a whole. When companies raise money by selling shares, they can use that capital to invest in research, hire more employees, and develop innovative products. This growth creates jobs, boosts consumer spending, and drives economic progress. In this way, the stock market acts as a barometer for the economy's health. When the market is doing well, it often reflects optimism about the future. But when it's struggling, it can signal economic uncertainty. Of course, the stock market isn't without risks. Prices can be volatile, rising and falling rapidly based on news, rumors, or even global events. Take the 2008 financial crisis, for example. Stock markets around the world crashed as fear and uncertainty gripped investors. People who had invested heavily saw their portfolios shrink overnight. But on the flip side, those who stayed invested and even bought more shares during the downturn eventually saw significant gains as the market recovered. This brings us to an important question. Should you invest in the stock market? The answer depends on your goals, risk tolerance, and time horizon. Investing in the stock market can be a powerful way to grow wealth over the long term, but it requires discipline and patience. For example, instead of trying to time the market, buying low and selling high, many successful investors adopt a strategy called dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. Over time, this strategy can help smooth out the ups and downs, making it easier to stay invested. Another key concept to understand is diversification. Imagine putting all your money into one stock, and that company suddenly goes bankrupt. You'd lose everything. Diversification means spreading your investments across different companies, industries, and even countries. This reduces risk because even if one investment performs poorly, others might do well, balancing out your overall portfolio. The stock market is much more than a place where people trade shares. It's a vital component of our economy, a platform for innovation, and a tool for individuals to grow their wealth. Understanding how it works, from the basics of buying and selling to the broader economic implications, is essential for anyone looking to navigate today's financial world. But the stock market is just one piece of the financial puzzle. To truly understand the future of money and investment, you need to explore emerging technologies like cryptocurrency. Curious about what cryptocurrency is and how it works, we will explain this in our next video, where we'll break down the basics of this revolutionary digital currency. And if you missed our previous video on how interest rates affect the economy, it's just a click away. Thanks for watching, and don't forget to like, subscribe, and hit the bell icon for more engaging videos about economics.